stochastic from the daily time frame, a very nice cycle. And then here above the 80 level, we are seeing a cross again lower. So now we want to look for a bearish opportunity. And again, we're able to put a price into a pattern. We're able to put a price into a resistance support level. You can see previous resistance is turning into support. We have here lower highs, so we could draw a trend line here at the top as well. So we have kind of a triangle reversal. And what we want to do is we wait for a breakout. And then this is how we could time our trades. You can see this is what happens afterwards. We have a very nice stochastic cycle to the downside, and then here another cycle would have started here at the downside at the bottom. And the stochastic cycle, obviously nothing works 100% of the time, and sometimes those will fail, but it can be a great opportunity and a great strategy to use. Or if you trade any other strategy, you could use the higher time frame stochastic just as another layer of confluence to your trading. So I've talked a lot about Fibonacci's and how do you find Fibonacci's. So a first tip would be to look for a Fibonacci sequence, an ABC, into a new trend. So when the market is going from downtrend here to an uptrend, what I do is I look for the first ABC pattern. And then you draw your Fibonacci tool from point A, the lowest point usually of the previous downtrend, to point B, which is the first swing point on the way up. So you can see the market broke the last swing high here. Then it came to an end and it gave us the retracement. You can see we have A, B, C. We have a perfect 61.8 retracement. The better your retracement, the better the Fibonacci in general is. So you really want to see that the price action is paying attention to the Fibonacci level. Otherwise, it's not super recommended to trade it because the Fibonacci is not very obvious. And the more traders that are able to use a Fibonacci or able to find a Fibonacci, the more powerful generally the signal. So A, B, C, and then how do you trade that? There are a few options. You could, for example, wait for the market to break above point B, above the 100, or some traders, they then look for patterns around the point C. So if you go now to a lower time frame, you're probably able to see here a double top pattern, an exhaustion pattern, and then time your trade here as well already. And you can see this is where we drew the Fibonacci. You can see the market went to 161, went to 200, and then the market died down. So I can't stress this enough. If you want to look for Fibonacci targets, 161 is the one that I would always recommend in the beginning. And if you are a little bit more advanced and you don't have problems with holding times, then you could also choose 200. But generally, most traders start with 161. Another example, in a downtrend, you can see the market was moving higher. Then the trend has turned. The market broke out of the trend line. So when this happens, the market is actively shifting from uptrending market to downtrending market. And at the beginning and at this shift from one trend to another trend, that is where I want to look for a Fibonacci. So I want to see where do we have our first ABC. Our first ABC happens from point A, the highest point of the previous uptrend, to the end of the first swing wave. Then here you can see we have a 50% retracement, and then we could use a 161 as our target. You can see in this case the market really overshot it, but this is very important. This doesn't happen all the time, and very often the market will turn already at 161. But you could again use such a strategy to exit partially 161, scale out 200, scale out 261, and then completely close your position. It's a little bit up to you. Again, I would recommend to just exit the trade fully on the first one and then wait for the next trade. No swing trading video is complete without a moving average crossover system, and here we have one where we use the 10, 20 and 30 period moving average. We can use EMAs, SMAs, doesn't matter, 10, 20, 30. So we have 3 moving averages which are pretty close by, and the idea of this approach is that we want to wait for the first break and retest through all of the moving averages. So we want to really see that the market is making a move from below above all of the 3 moving averages, and then we are waiting for our first pullback. So you can see this green candle broke all of the moving averages, then the next 2 retested it, and then this is where we would start looking for buying opportunities into the new uptrend. The market is coming from downtrend, changing the directions. It's very tough to break all of the moving averages after a trending market, and then this is where you want to look for opportunities. You can see this is then where you get into a trade theoretically after the retests have been confirmed and after the market has moved higher. So a big problem and a big mistake that many traders make with retest or pullback trading is that they enter when the market is actually performing the retest, but you really want to make sure that the market is moving away from whatever you are seeing being retested. Even if you're looking for a head and shoulder retest after the breakout, a Fibonacci extension or retracement, you always want to make sure that the market is showing you a reaction away from whatever level you want to see being retested. And this is then where you look for trend following entries. You could also use then another or later pullbacks to add to positions. So here was our first opportunity. The market continued and moved higher. We have our first consolidation back into the moving averages. The market didn't break below the moving averages, which is very important. And then you could draw a triangle here, a trend line, and then wait for continuation patterns. So a few options, what we have already learned, we can now start putting together to form a very, very robust approach. And this is what happens afterwards. You want to make sure that if you are in a trend, you want to make sure that the moving averages are not being crossed to the opposite side. A cross to the opposite side would really signal the end of a trend, so make sure to pay attention to that. One of the most popular moving average crossover systems is the so-called golden cross, and here we use the 50 and the 200 period moving average. So this is how it looks. We have the 50 and 200, and the horizontal, the vertical lines mark the crosses of the two moving averages. And the idea is that whenever the two moving averages cross, you are looking at a new trending phase. This is ideally used for a multi-time frame swing trading strategy. So here you can see the lower time frame, the lower moving average, the 20, is crossing above it. So at this point, you have the beginning point of an uptrend. So whenever this cross happens from now on, you're only looking for buying opportunities on the lower time frames. And you can see this could have been a quite profitable endeavor. Here you see that the moving averages are crossing into the opposite side. So from this cross onwards, you're only looking for short opportunities to the downside. Here, the next cross. From this moment, you're only looking for buying opportunities into the new trend direction, and so on and so forth. So basically, the daily time frame crossover or golden cross would be your filter. Whenever you see such a cross, this determines the trade direction for the lower time frames. And